Hey, what's going on, guys? It's Jonathan Smith. I want to talk to you today about qualifying for a mortgage. Um, and really, the main part of that is like your debt to income ratios and why it's so important to have your finances in order when it comes time to buy a house. So, when we talk about debt to income, because people ask me all the time, well, how much can I afford? Well, that's not a question of credit score necessarily, although your credit plays a part in it because of your debts. Now, what a lender is going to do is they want to look at an overall picture of your finances and if you can afford to make the payment every month. Well, the way that they do that is through debt to income ratios. So what they're going to do is they're going to take your income and then they're going to allow you to have a certain percentage of it allowed to spend on regular debts, and then also an amount that's going to be on your housing. So you have two different types of debt to income ratios, and that's your front end and back end ratios. So the first one is going to be what is your overall debt payment per month with the house. So for example, you have two credit cards and the minimum payment on them, because they both have a balance in this scenario, they both have a minimum payment of $100, so that's $200. Then you have a $600 truck payment, so now you have $800 in total debt. Now, let's say the total debt allowance that they'll allow you is $4,000 per month in total debt. So you have $800 already in every month recurring debt payments that you're making. So they'll allow you in this particular situation to have like a $2,200 payment, or I'm sorry, a $3,200 payment. $4,000 of income that they're going to allow you to spend money on debt on, and then all your debt payments combined with your housing. But you have a second debt to income ratio, which is your housing only allowance. So in this case, maybe you make $10,000 a month, and they allow you to have 40% overall, but they're only going to allow you to have maybe 25% towards your housing payment. So in that case, even though you have a low amount of debt, maybe they'll only allow you to pay $2,500 per month on your mortgage payment. Now, let's look at that in the reverse. Maybe you have two car payments, student loans, a personal loan, and some credit cards. And your monthly payment is $3,000 a month between all of those. And they're only going to allow you to have $4,000 overall, and so your qualifying amount might only be $1,000 a month that you can use towards your mortgage. Well, you see how that's going to be a problem. That's why it's so important to make sure that your credit cards are paid off. One, you're saving money on interest. Two, it helps your credit score. And three, it gives you more money that you are allowed to spend on your house. Because what you don't want to happen is you go to purchase your first property or your first investment property, and then you find out, oh, you spend too much money on car payments and credit card payments every month, and you don't have anything left over that you're allowed to use for housing. And I have people tell me, well, I spend $1,500 a month on rent, and they're only going to qualify me for $1,000. Well, that's why. Because they're only going to let you spend a certain percentage of your income on housing expense. And they're only going to let you spend a certain amount of your income on overall debt payments, right? You don't want to be a slave where all of your money just goes to paying debt payments. You don't have any money for food, electricity, all these different things that you're going to want to spend money on, or savings, so making sure that your debt to income ratios are lower is super, super important. It's something you're going to want to keep a close eye on. If you like this video, go ahead and like and subscribe down below. If you have any other questions or ideas for me, go ahead and leave a comment, and I'm going to be bringing more to you soon.